if I look at this and you say, give me 5 growth stocks that you believe could blow up over the next 10 years, I'm talking multiples of where we are, crushing the S&P. I'm starting with Tesla. Tesla's the one that they continue to do things, and the opportunities Tesla has over the next 10 years to come up with robotics, anything else they're into, the cabs, the trucking, the insurance, the autonomous driving, you put in anything else they come up with. Remember Apple before they invented the iPod. They can do things here at Tesla. And so as I look at this, and you see this year alone, 75.74%. And yes, we were doing videos back in early January on this. This is one, even though you've seen it grow this much, this company's going to be worth trillions of dollars down the road. I'm talking, like I said, down the road, down there. When you look at a 10-year time frame and you're looking for a portfolio and you're looking for long-term plays, the dollar cost average through the years, in my opinion, Tesla's going to be one of the best. They got China, that they have been crushing it. The US, which are just getting ramped up. They just lowered price. They're going to dominate in the US, Europe as well. And put it all together with the opportunities that they can do some crazy stuff moving forward, combining robotics, AI, autonomous driving. The future is so bright. They got the energy part of Tesla. It's not just an automobile company. This thing is a monster of opportunity. And so I love it. I love this one. I think it gives us a lot of chance. And of course, this doesn't hurt for this year for the short-term buyers. The credit boost will help, and they kind of redefine some things, and it's a big win for Tesla.
We'll be looking at Amazon. I personally think Google is the most attractive stock just in the entire market in general, but Amazon is also an extremely solid choice, and I've been buying both stocks super heavy either way. But taking a closer look here at Amazon stock, I would say that right here at around $100 and below is an absolute steal. So I'll be unloading the truck on this one all year long. And I can give you 3 quick reasons why I feel this way. First of all, from the top, Amazon stock is now down a mind-blowing nearly half of its entire value. To give you some perspective, this is about the same price range as their pre-pandemic levels, which is leaving their price to sales ratio about 40% lower than their 5-year average, since they're still growing larger even as the price falls. The market cap has also fallen now from close to $2 trillion down to just about $1 trillion today, making it the only company in the world to lose $1 trillion worth of value. But mark my words, guys, Amazon will eventually be a $2 trillion company. In fact, I even think it'll be a $3 trillion company over the long term. But in the meantime, the reason why this crash matters so much does bring me to reason number 2, which is that the stock price is trading now as if all of the gigantic growth from the pandemic never even happened. Yet we know that during that time, Amazon's revenue skyrocketed from around 280 million all the way up to over $500 billion, and they're still expected to grow this year by a double-digit percentage at a time when everyone is predicting an economic recession. That's wild. This is a much larger company now, yet they're trading way lower. And that brings me to reason number 3. They're going to only become even larger in the future. If you look at capital expenditures, you can see that Amazon is reinvesting most of that money back into the business to ensure they dominate the future of several different markets. In fact, CapEx went from 17 billion in 2019 all the way up to over 65 billion this past year. I mean, how many companies can you guys think of that spend that much money on capital expenditures and growing out their business every year? It's unheard of. Whenever Amazon decides that growth is no longer the priority, but rather to focus on profits, all they have to do is flip a switch, guys, and they'll go from being one of the least profitable companies to one of the absolute largest, most profitable companies in the entire world. And that's the future that I'm investing in, because as it stands, Amazon already dominates some of the biggest markets in the world, including online shopping and cloud computing, and they're quickly becoming much bigger threats in other areas too, like digital advertising and video streaming, and they might even become huge players in other large and growing markets too, like EVs with Rivian, or pharmaceuticals, or artificial intelligence, or gaming. There's really no limit to what Amazon can do or what they're even willing to do. I mean, remember when they actually launched a smartphone back in the day? Now, it wasn't successful, but they were willing to do it. And honestly, I wouldn't be surprised if Amazon tried to launch a smartphone once again, because they already have the whole Alexa ecosystem that they continuously release hardware and products for. So why not build on top of that with a smartphone as well? And you even already have the Fire OS, which you can build on top of, or just kind of merge with Android and have that have the phone be running on that too. But either way, the great thing about Amazon is that they're willing to take any risk, and they really don't care if it loses them money in the short term. And that's really what investors are always worried about when it comes to Amazon, is the profitability. But what they don't realize is that Amazon is this giant dominant company that is still taking risks and still investing in growth as if they were a young startup. And that's why they continue to become larger and larger over time. And when it comes to profitability, they can flip a switch at any moment and they can quickly become one of the most profitable companies in the world. But I love what Amazon is doing, and I love seeing them just continuously adding to their business and taking more risks. And we continue to see that. I mean, we just recently saw them acquire MGM just to add more content to their video streaming service, which they're practically giving away for free. I mean, you have to have a Prime subscription, but that's all they care about. They care about just users getting onto a Prime account, not necessarily monetizing the video streaming part of their business. They just want to get more and more users. In other words, they just want to become larger and more dominant. And when you have a company like that, that's a dangerous company. I mean, in terms of it just becoming larger and larger.
Being said, let's go ahead and dive into my first and largest position overall, which is Datadog. Datadog I currently own 330 shares of at a value of just under $23,000, and that's off an initial cost basis of $32,000. So this stock has lost around $9,500 over the period that I've invested in it. And you can see that Charles Schwab gives this stock a D rating. In fact, it gives most of the stocks on this list either a D or an F rating, but that's because the way Charles Schwab rates the stocks is based more on a value metric and less on a growth metric. I've had stocks in the past that Charles Schwab told me were an F that returned 300% while I invested in them, like CrowdStrike. So I don't really put a ton of weight into Charles Schwab's ratings of these companies. So Datadog is a data company. They unite a company's applications, infrastructure, and security all through a single pane of glass, and they do it extremely well. We know this because if we take a look at their dollar-based net retention rate, it has been over 130% for the last several quarters. This means that even if Datadog didn't sell a single new customer, they would grow at 30% per year just by selling more to their existing customers. Datadog is also benefiting from a few broader trends in the market, including data and cloud. As more and more companies move into the cloud, they're going to generate more and more data that needs to be analyzed. And this coincides with the trend of companies just producing more and more data that they want to use to get value from it. They say that data is the new oil, but similar to oil, it's not valuable unless you can grab it, you can refine it, and you can actually use it for a useful purpose. That's what Datadog does for other companies. Datadog is also growing very quickly, growing 61% in their most recent quarter. And while this is a slight decline from the growth that they saw in some of their previous quarters, this is just because Datadog is reaching such a large scale that the percentage growth is looking smaller, even as the absolute growth is still continuing. So as more and more companies produce more and more data and need someone to help them analyze it for them, Datadog is positioned extremely well to take advantage of that growth trend.